All right. Thank you guys for joining. So I'm going to share a little bit about what's happening in the real estate market. I get this question all the time. Jackie, what's happening in the real estate market? So I'm going to give you the download. I work for Your Castle Real Estate, and we are the largest independently owned brokerage here in Colorado. And we do a ton of research on trends and reporting on what's happening, whether you're a buyer, a seller, or an investor in the real estate market. So there's always a shift that's happening in the market. So my mindset is, what does that mean for you? So there's always advantages and opportunities. So we're going to dive into what that looks like. So here's what we're going to go ahead and cover today: the current state of the real estate market, why we have a shortage of homes for sale, recession. Are we in one? Are we not? Are we approaching one? So we're going to talk a little bit about that, how mortgage rates are impacting the market, and what this means for you if you are a buyer, seller, or an investor. So who am I? I'm Jackie White. If we haven't met before, I'm a realtor here in Colorado. I've been in this business for over a decade, helping folks buy, sell, and invest in real estate. I work for Your Castle of Real Estate. Like I mentioned earlier, the largest independently owned brokerage here in Colorado. But outside of real estate, I am a mom of two kids and a youth sports fan extraordinaire. So I always run around to their events. I love to ski, even better, après skier. I used to be in marketing, so working for some Fortune 500 companies, putting together their marketing plans and strategies. Also, I've been a real estate investor since 2012. So if you're interested in investing, give me a call. I can chat your head off for hours about those strategies. And I've been a realtor since 2014. And over the years, I've also gotten very involved with wildfire prevention. I currently serve on the board of directors for Inter Canyon Fire Protection District in the foothills of Denver, and have also been very active in sharing, how to best harden your home and protect yourself from wildfire. Over the years, I've been lucky to work with a lot of clients, and as of August 2022, closed my 250th transaction, which is a lot over time, but it's been a lot of fun. Made a lot of friends along the way, and clients that have become friends. So I've been very fortunate when it comes to that. So let's jump into this a little bit more about what's happening in the real estate market. So, of course, you guys have probably heard some stuff in the news about what's happening? Are we approaching a recession? What's going on with interest rates? And as you can imagine, with any news outlet, they like to sensationalize things because obviously it gets more clicks online and more interest from folks on TV. So keep in mind, there's what they're reporting, and then there's the reality. So keep in mind, over the last couple of years with the real estate market, it has just been a fury in terms of people buying houses very quickly, interest rates being very low, and a very swift market. So what myself and some friends call it has gone from a hot to a spicy market. So still not quite as crazy it was over the last couple of years, more of 2019 conditions. And remember, regardless of what the real estate market is doing, it always is going to present some opportunities. And so it's just a matter of what that is for you. So I'm going to share some data here that I wanted you to understand as far as what's happening in the Denver metro area. So all these charts we're going to go through are for the Denver metro area, the Front Range foothills, just kind of encompassing that whole area. Okay, so it's not necessarily neighborhood specific, but if you want to dial down to your neighborhood, give me a call. I can give you some more details. So you've probably heard about prices going up and people feel like, oh my gosh, their houses are so expensive compared to the way they were, right? So when I moved to Colorado in 2007, the average home price was in, the mid 200s, right? And this represents the average home price, the solid line, dotted line are condos and townhomes. And over the last 45 years, we've had about 6% appreciation annually. Now, this dip here represented the last recession that we were in. Actually, prior to 2020, believe it or not, we had a recession in 2020 for a brief time frame. But this was the one that was fueled by the banking crisis and mortgage-backed securities. So home prices did dip, but overall, they have been increasing over the last 45 years, and especially in the last 2 years, we've really seen a leap. So, we're looking at the mid 700s now in terms of the average home price here in the Front Range. Now, just because we talk about recessions doesn't mean that that's going to lead to a housing crisis. Now, economists are all pontificating on, are we in one, are we not, or when are we going to be there? I don't know. It's so much easier to look in the rearview mirror and determine that we have been in a recession. But let's look at what the last 6 recessions look like going back to the 80s. And as a matter of fact, of the last 6, only 2 of them did home prices fall. So in the early 90s, about 2% home price depreciation. 2008, we saw close to a 20% depreciation, but keep in mind, that was fueled by the banking crisis and a lot of lending practices that are no longer in place. So a lot of times when people think about recession, they are reminded of 2008, and we don't see that happening again. As a matter of fact, in 2020, we had a recession for a brief time period when COVID first broke out, and we actually saw an increase in home prices of 6%. So keep in mind, a recession just represents slowdown in GDP, but it doesn't mean that home prices have to fall. There's so many other factors that drive what homes are worth. Now, remember, again, 6% a year is what we've seen for average appreciation over the last 45 years. And in the last 44 years, home prices went up all but 4 years. And that's during that recession in the late 2000s, I guess we could call it. So it doesn't mean that home prices have to go down just because they've been going up. A lot of people say that what goes up must come down. That's not the case in housing. Love this chart. So this kind of gives a historical perspective on what's been happening in our marketplace when it comes to inventory. So this solid line is the number of active homes on the market, and the dotted line are those that actually sold. So the gap between the two is the inventory of homes that were available to purchase. Now you can see on this bottom line here of the homes that sold, there's a wave, and that represents seasonality. There's certain times a year where there's more real estate activity than others. But keep in mind, back in February 2007, we had a lot of houses on the market. These were all bank-owned properties, foreclosures, and homes that simply didn't sell because there wasn't the demand. And at that time, we had what's called a buyer's market, okay? Started to become a little bit more balanced in 2009, 2010. Starting in August of 2011, it became more of an efficient seller's market. So, homes were selling, but it wasn't this crazy deal that we've seen over the last 2 years. That was actually a dysfunctionally tight seller's market. That's where buyers were having to offer significantly over the asking price, waive their inspections, and give their firstborn child in order to get that home under contract. That's just not sustainable, truly. A lot of that was driven by people being interested in moving because they were stuck at home, quarantining. It makes you evaluate your space like, gosh, is this a big enough office? Am I happy with my kitchen? Honey, do you want to remodel or should we just move, right? And people working from home could go anywhere in the country. So it gave them a lot of flexibility. Part of that was people moving to Colorado. We've got beautiful weather, all sorts of outdoor activities. They were seemingly safer in early COVID days. So you didn't have to sit in a movie theater. You could go for a hike, go skiing and be perfectly fine. So in this dysfunctionally tight seller's market, low interest rates were very prevalent. 2.5%, 3% interest rates were quite the norm. That's just not the case today. So we are now entering back into this yellow phase of this efficient seller's market where there's a little bit more inventory and availability of homes. Speaking of inventory, this represents the number of active listings by year. So listing is a home that's available to purchase. So look at 2019. Starting in January, we had about 6,000 houses on the market, which is still low. We're again in a seller's market, but at the beginning of the year, not as a lot of inventory, kind of peaked over the summer. And then in the fourth quarter, things slowed down a little bit because most people don't think about moving during the holidays. Here is 2020. We started out at a reasonable clip and then, COVID hit and then all of a sudden people were out buying homes and we just didn't have any inventory. Well, let me get back to that slide. 2021, we started out with even less homes, 2,000, a third of 2 years prior, and we were bummed along with not a lot of inventory. However, starting around May, interest rates started to increase quite a bit and the number of homes went up. It costs a little bit more to buy a house at 6% mortgage rate than it does at 3 or 4%. So homes were sitting on the market a little bit longer. Okay. And then, 22, really, that's what we saw happening is the interest rates that were impacting the days on market and the inventory. Now, we don't have our data points for the first quarter yet. We'll be getting those pretty shortly. It'll be interesting to see what our inventory looks like. All indications of it, all the data is indicating it's more like 2019 numbers. So why is our inventory so low? Well, during the last banking crisis, which was in 2008, 2009, builders started getting a little bit cautious about beginning to build more homes. They had all had a lot of financial difficulty, and so not all of them, but a lot of them. And in doing so, they became cautious in building new homes. So when you look at the average number of homes that were built over the last decade, it was significantly less than decades prior. So we just haven't been keeping pace with what we've been doing in years past. Layer on top of that, the millennials that have hit a median age of 30 and are actually the largest percentage of the population here in the Denver metro area, that milestone birthday, they're thinking about, geez, maybe I want to get married, maybe I want to buy a house, start a family, and they're creating a lot of demand for homes as well. Something we look at, and you've probably heard these terms, are what's called a buyer's market and a seller's market. And that's really defined by something called months of inventory. So we have the same number of buyers, same number of sellers. Don't add any new buyers, don't add any new sellers. How long would it take to deplete that inventory? So basically anything over 6 months is considered a buyer's market because you have more homes than buyers that are out looking. And so buyers have a little bit of the upper hand when it comes to negotiating. Anything less than 4 months is considered a seller's market. And this is where sellers have the upper hand because there's a lot of demand and not enough houses. So the last decade, we've certainly been in a seller's market, and you can see the very tight seller's market in 2020 and 2021. So instead of having our hair on fire like we have the last 2 years, we're getting to a more normal pace. You still have to be decisive if you're a buyer and get your home ready if you're a seller, but it's not quite the way it was the last 2 years. And I don't know if we'll see that again. It's hard to say. Something that we noticed over the last couple of years is that there were a lot of showings on homes. And a showing is when a buyer walks through a house with their realtor because they're interested in it. And with a lack of inventory and a lot of demand, we had very strong showing traffic for a few years. So here's 2020, this purple line. So imagine it's January, February, kind of hearing about this COVID thing, not quite sure what it is. Middle of March 13th, I remember, we started to quarantine and whoop, there goes the showing traffic, right? It just dipped. I mean, there was a period where we could not show houses. Once things opened up again in early May, you can see it pop back up. And then things were really coming along in terms of people looking at houses. Now you can see these little dips here. This is like 4th of July, Thanksgiving, Christmas. People are looking at that time frame. But overall, buyer traffic was pretty strong. Then we get to 2021, and that started out pretty strong, significantly over the previous year. 22 was even greater, but as interest rates started to go up in the second quarter of 2022, the showing traffic went down because it became a little less affordable to buy a home. And so some buyers decided to take a break. Maybe they were going to rent for a little bit longer and see how things played out. So that really led to the demand mirroring 2019. And I tell you, pre-COVID, 2019, we all sold a lot of houses, helped buyers buy houses, and nobody was stressing out. So we're getting to more of a normal seller's market environment. Keep in mind, though, even though we talk about it becoming a little less crazy than it has over the last couple of years, we still do have an inventory issue. So we've got a lot of people moving to Colorado, a lot of people looking for houses. And when you look at the history, the average number of homes per sale per 1,000 people in the Denver metro area is about 6.7 homes. And right now we have 0.8 homes per 1,000 people. So we don't have enough homes for people to go buy. So this is adjusted for the population growth that we've seen here in Colorado. And local economist Patty Silverstein, she's well known, looks at all of this, and really we are finding that with the growth that we've seen and the lack of new homes being built, we're going to be in this situation for quite some time, just given the current demographics of our population in Colorado and what's being forecasted. We're going to continue to see some growth. So it's, in my opinion, and a lot of the data is pointing at, it's going to stay more of a seller's market for some time, it appears. So what does this mean for you? As long as the inventory of homes is low, buyers, you're going to have to write some decent offers. The days of being able to lowball and really just give it to the seller, it's honestly, it's not going to you're not going to bode very well as far as getting your offer accepted. Seller will generally have the edge on negotiations, and then investors are going to seek strong rents because you're going to have some people that are afraid to go buy a house. Maybe they don't qualify. So they're going to choose to rent, and that's just going to create a lot more rental demand as well. Something that I think is pretty unique is an opportunity for Foothills homeowners at the moment. So right now we've got the Foothills, which is, foothills of Denver. So you're talking about Golden, Evergreen, Morrison, Pine, Bailey, Conifer, that whole area. You guys are all in a unique situation. So listen up. We still have a demand for mountain homes. People move to Colorado and their mindset typically is being in the mountains and having access to all the activities that they offer, whether it's hiking, mountain biking, skiing, all the things that you can do outside, having a little bit more elbow room on your property and having a bigger lot. So those homes are generally in demand. However, the houses, as we use the term down the hill, so out in Denver, that market's becoming a little bit more balanced because you have more of a homogeneous inventory or product. So, some of those same builders that were building homes in Stapleton or Highlands Ranch, or Thornton or Broomfield, you can find generally that same product throughout the Denver metro area. But the Foothills, there's not a whole lot more room to build. So the inventory is the inventory, and it's a pretty unique thing. So if you are thinking about selling your house in the Foothills, you're in a position where you can have a strong price point on your house in the Foothills where there's a lot of interest from buyers. And if you're moving to Denver, maybe you're downsizing, getting lower elevation, or moving out of state, you have the opportunity in cashing out that equity that you have in your current home and buying something else, maybe for cash. Maybe you get a little bit extra nest egg to go travel or use in retirement. So by maximizing the price of your house in the Foothills, you have the opportunity to go buy something perhaps a little bit more affordable. Now, something I want to talk about, especially when we look at affordability, is mortgage rates. So as I mentioned earlier, during the early days of COVID, we did have some extremely low interest rates. 2.5%, 3%. It's just not sustainable when it comes time, for the banks to make money. They've got to make money on these loans. And it does cost some money to process them and, do all of the work that's required to create the loan. So at the end of the day, it was something that was very desirable for buyers, but not sustainable. So if you look at the interest rates today, we're in more of like the mid sixes. And that actually is the average that you've seen over the last 40, 50 years. And, I've talked to a lot of folks that bought houses in the 80s and they were having interest rates in the teens. So when we look at stuff that's in the mid sixes today, it really is kind of the average of the last 40 or 50 years. Keep in mind too, during the heyday of the COVID real estate timeframe, if you listed your home for sale at $700,000, you might get more than you were asking, and a buyer would really have to put extra money down, maybe waive the appraisal, provide a gap insurance on the difference between the appraisal price and the sales price. You get a lower interest rate, and roughly this would be your payment. Today, if you're out buying a home, there's a better likelihood you're going to get closer to the asking price, or maybe a little bit under. And if you have a little bit higher interest rate, you also were going to have a higher payment, but keep in mind, you're not having to put that extra money down to make sure you bridge that gap between the appraisal and the purchase price. Or what I saw a lot of is buyers just inheriting these houses that, they couldn't really push back on inspection items. So if the deck needed to be replaced or the roof had issues or, the hot water tank was old, they just kind of had to take the house as is. Now I'm seeing a lot more conversations happening between buyers and sellers and negotiations when it comes to inspections. And so this puts buyers in a little bit better position in that they don't have to have extra money set aside for after their purchase to fix those issues with the house. When it comes to purchasing a home and having a mortgage as well, we've heard this term of the saying, date the rate, marry the house, and divorce the rent. So for renters, if you're paying a rent, the only person that you're benefiting is the landlord, right? Because they're the one that owns the home and you're paying the rent. But there are options here where you can find a house, lock into it, and just date the rate, because there's things that you can do like refinancing or buying down the rate to allow your payments to come down. Something that we talk a lot about is a 2-1 buy down as well, and we'll get into that in just a moment. So when you marry the house, you find the house that you love, that's going to fit your family's needs right now, and you keep it for the long haul. Remember, real estate is not a get rich quick situation, and most people stay in their house 5 to 7 years before they move on. So think about what it is that you need for your home and for your family. You can always change the rate by, refinancing, asking the seller to pay some points to get a lower rate, and this can make a bigger difference. But get the house that fits your family's needs. I'd hate to see someone staying in a home, like for instance, if there's stairs and going up and down the stairs becomes painful over time. Get the house that's going to make you comfortable and work for your family, because you can always modify the rate. Now, we talked a little bit about 2-1 buy downs. This is a unique product that we're starting to see return. And what this means is that you pay some points or, some fees at closing. Now, it could be negotiable, could be you or the seller paying for this. And in the first year, you're going to save 2% on your interest rate. So let's just say, for argument's sake, interest rates are 7%. Year one, your payment is going to be based on an interest rate of 5%. In year two, your interest rate will be 1 point less, so it'll be 6%. And then the third year, you go to a fixed rate. Now, in this 3-year time frame, if interest rates come down, and they may not, can't promise it, but indicating that will probably be the case, you can refinance and lock in on a 30-year mortgage at the rate that you would like to have for the long haul. So this is an option that will allow you to save some money in the interim too. So just something to talk about with your lending officer. So what are economists predicting for 2023? And keep in mind, these are all predictions, but here's what they're saying, okay? So they're looking at home prices. Redfin says they'll fall. Zillow says they'll be flat. Realtor.com says we'll see appreciation. So are any of them right? Somebody is, but it's just a matter of what the end result is going to be, right? Nobody really knows. Now, home sales, we have seen the volume decline, but just because the number of homes that are being sold goes down doesn't mean that prices are going down too. Some of this is driven by the lack of inventory again. So with higher interest rates, you may see less people buying, but if there's less homes to buy, there's still going to be a fair amount of demand, and those prices will likely go up. And I've seen that already this year. Now, the National Association of Realtors chief economist says that they're expecting home sales to decline by 7%, but prices to go up. And this is on a national level. Keep in mind, it's going to vary by geographic area. So other things that are going to influence the market this year is, broader U.S. global, economic health, what's happening in the stock market, inflation reports by the Fed, just general overall consumer confidence. As the Fed meets periodically, they tend to adjust rates, and that will drive buyer behavior. They feel like interest rates are going down, they might be more likely to purchase, and vice versa. The labor market is going to impact things as well. If there's layoffs, you may see a slowdown. But if we continue to have, low unemployment, I don't know if that'll be the case. And then, things that are happening overseas, sometimes that impacts consumer confidence. If there's political issues, in Ukraine and Russia and China and other parts of the globe, and it gives people a little bit of pause, sometimes I see that. But generally, if a buyer really needs to move, maybe they have a job change, maybe there's someone that has a death in the family, and now that home needs to be sold, or maybe there's a happy occasion and a family is growing. There's going to be things that will drive real estate transactions regardless of what's happening in the economy and across the globe. Now, inflation is something we've talked a lot about. I know when I go to the grocery store or buy gas, things have certainly gotten more expensive. I'm sure you guys have noticed that too. But some of the things that we're seeing in the reports is that the rate of inflation is slowing down, thank goodness. And so this is helping when it comes to some of the Fed's reaction and not switching the interest rates quite so dramatically. Starting in the second quarter of last year, it was almost like they were throwing a bucket of water on fire because those rates just cranked right up super fast. We were in the mid threes in like April, and by August we were at 7, which was absurd. A little bit more of a scalpel approach to the interest rates would have been nice, but they just took a hatchet and were cutting away at things and making adjustments. So hopefully things are a little bit more stable at the moment. It seems like they've been that way over the last couple months. And so people are just kind of getting used to the new norm. 2.5 interest rates are a thing of the past. Now, a good sign is that mutual funds that invest in stocks that benefit from slowing inflation, that has been increasing. So I don't know, those Wall Street guys might know what they're talking about. So what's interesting to me is that as we look at migration and inventory, a lot more people working from home now. We're all on Zoom. We're all doing our thing, from our home offices. That has allowed a lot of buyers to move around the country, maybe get closer to home, closer to activities they enjoy, or even to cheaper parts of the country where they were able to buy more of a home. But one of the things I wonder about, and I'm starting to see this a little bit, is as people were locked into these super low interest rates, it's making them a little reluctant to move, even if it's necessary for their family, because they want to just hang on to that low interest rate. As a matter of fact, I saw a chart yesterday, I believe it was about 25% of the country either refinanced or purchased a home in the last 2 or 3 years, and the interest rates were, 3% or so. So we've got a lot of people that are really locked into these low rates. And if they choose not to move because they feel like they have a really affordable monthly payment, is that going to lead to less inventory? It's less homes available for purchase, and that will just drive the prices back up again. So, and if there's no new construction, again, no inventory, not enough homes to buy, and prices will continue to go up. Of course, that's going to vary, throughout the U.S. From a geographic standpoint. Some of the areas that could see the greatest growth are the Mountain West, Sun Belt, the Carolinas, Texas, and Florida. But the most, this is the deceleration. The most stable markets, though, tend to be in the Rust Belt. So Ohio, Pennsylvania, upstate New York, that's where my family's from, Kansas and Iowa. These are all areas that are going to be probably a little bit more stable, or maybe see some growth because they are more affordable. Now, I've had a lot of people ask me, when's the foreclosure opportunity going to come up? It's usually those investors, right? They all want to get a great deal on a property. But keep in mind that there's a lot of people that have a lot of equity in their homes. And let's say they fall on hard times. They lose their job, get sick, can no longer work or something, and they're getting behind on their payments. They likely have a lot of equity in their house because values have gone up 40 to 60% since about 2019. So if they fall behind, they're in a position where they can put their house on the market, sell it, take that equity, move on, rent, figure out their situation, let that stabilize before they become a homeowner again. And even if the values were to go down considerably, we're still going to be up from where we were just 3 or 4 years ago. So there's still going to be a lot of folks that have equity in their home and they have choices as opposed to just sticking their head in the sand and letting it go to the auction. We still have a strong labor market, so not seeing a lot of layoffs where that would put people in a position that they could lose their home. And the National Association of Realtors also was surveyed, and in 2008, 49% of members were working with a distressed property, and in September 2022, it was only 1%. So that's a dramatic change in terms of the number of people that are facing foreclosure. So I just don't think we're going to see a lot of delinquencies or opportunities as some people have considered it to go buy a cheap home. Also, as you look at this, let's contrast the current market versus 2008. So we look at job cuts. We haven't really seen a whole lot of layoffs, and there were 8 million jobs that were lost in 2008. Subprime loans were very prevalent in 2008, not today. New construction, much smaller than what was being built, over a decade ago. The inventory on the market in 2008 was 3.8 to 4 million homes and only about 1 million today. Mortgage delinquency was about 3.6%, and it was about 10% in 2008. So 1 in 10 homeowners was behind on their payments. So less than a fifth of homes in foreclosure as well. So just don't see this as being this big recession housing crisis that we experienced in the past. So what does all this mean? If you're a homeowner and you're thinking about selling, keep in mind that you got to get the home ready and prep it, clean it up, and put some time into having it look great for when buyers are going to look at your home. Decluttering, staging, getting the house ready to go. The past couple of years, people were so eager to buy houses. They were buying anything, regardless of the condition, if it smelled, if it was dirty, if it was a mess. People were buying houses because they were desperate. Now you got to put a little bit more effort into it. So back to the old days. Multiple offers, 6 figures above asking, those are a thing of the past. So if you're a seller, you can't expect that you're just going to make a ton of money because people are going to be bidding on your house. Now, what I'm seeing right now is in price points under $1 million. If the home is priced correctly, great neighborhood, in pristine condition, you're getting a couple folks interested in making offers at once, but it's not the 15 to 20 offers we were seeing at any point in time from March 2020 and on. So you get a couple people interested, that's great, but we're not seeing the same fury in terms of people making offers that we were before. Now, keep in mind, buyers exist all year long. So there's buyers looking in the wintertime. Those are sometimes the most motivated buyers, and there's buyers looking in the summer. So there's buyers that are out there all the time. But the best advice I have is to don't get emotionally attached to the process and think about what works for your family's needs and act accordingly. Okay. If you got to move, if the house is not suiting your family, there's something else that's a life event that's happening, make the right decision. Don't try to time the market. And if you are a buyer, what does that mean given the current market conditions? Well, interest rates might be a little bit higher, but we are on the average of about the last 40 years in terms of interest rates. So it's really not that far off of what people are used to paying for mortgages. And you can always refinance or buy down your rate. So get yourself into a house that fits your family's needs. And the nice thing is you probably aren't going to be paying a premium above the asking price and competing with a whole lot of other buyers. So it might be a better time for you to be looking right now. And think about your family's needs. What works for you? Are you done with renting? Do you want to start building equity in a home? Now's the time. Now, if you're an investor, keep in mind, again, there's less competition. Sellers are getting a little bit more flexible. You're more likely to have an inspection and be able to have conversations and negotiations with the sellers. Rates are up, and it might cut into your cash flow if you're looking for a rental, but that can be just temporary, and you can, modify the rate. As we've discussed, there's a lot of options. So keep that in mind. And also rents are going up because people are moving here, just not a lot of houses. They can't find what they want to buy. So we're seeing a lot of increases in rent too. So while the interest rates have gone up, that might cut into your cash flow. If you have a rental, it's probably going to go up. And again, don't forget about the long-term benefits of appreciation, tax write-offs, renters paying down your principal balance. There's more than one way to make money in real estate. So it's not always the cash flow when it comes to the difference between the gross rent and your expenses. We're getting a little bit choppy here. It's coming. So key points to remember. Market conditions seen in late 2020 and 21 and with super low interest rates and a lot of demand, that was just an anomaly, kind of a once in a lifetime scenario, and don't expect that to come back anytime soon. People have to move all the time, regardless of market conditions. They have to buy or sell, and just think about what works best for your family's needs. That should be your main priority. Don't try to time the market. So if you have questions, always happy to answer any questions that you have about buying, selling, or investing. You can always reach me at any of these means here, phone, email, etc. Always happy to chat. And thank you for joining. I hope you have a great week, and thanks again. Bye.